Good afternoon. Welcome. Thank you for joining us here today. I'm John Lewis Howard, Associate Director of the Murphy Institute. And if I could, please ask you to silence your cell phones at this point. It's very helpful. Before we begin, in honor of those who inhabited this land before us, I present the Tulane Land Acknowledgement. With gratitude and honor, Tulane University acknowledges and pays tribute to the original inhabitants of this land. The city of New Orleans is a continuation of an indigenous trade hub on the Mississippi River, known for thousands of years as Bulbancha. And Native peoples have lived on this land since time immemorial, and the resilient voices of Native Americans remain an inseparable part of our local culture. With gratitude and honor, we acknowledge the indigenous nations that have lived and continue to live and thrive here. We're here today for the Yates Lecture. The Yates Lecture is the Murphy Institute's major public academic event designed to promote university-wide discussion of issues of current concern. The annual Yates Lecture brings leading thinkers and public figures to the Tulane campus to share their insights on a wide range of topics, from politics and economics to culture and the arts. The Yates Lecture was endowed in 1996 by Murphy Institute alumna Rebecca Yates Vellender, class of 1989, in memory of her mother, Mary C. Parker Yates. Rebecca Yates Vellender is an outstanding student at Tulane, majoring in political economy as a member of the Murphy Institute's undergraduate program. After graduating from Tulane, she went on to earn a law degree from Harvard University and has had successful careers in law and business. Now to introduce this year's speaker, let me introduce Dr. Gary Hoover, Executive Director of the Murphy Institute.
All right, so first off, I want to thank everybody for coming out in the rain. As I was telling Dan beforehand that we would have had a lot more students had it not rained, but rain and students are like, heat to snow. They just melt away. So for those of you who have come out, I really want to say thank you. Also, want to let you know what is it that the Murphy Institute does, right? So what are we interested in here? We're interested in the impacts of policy, broadly defined, on the market environment. And so what type of policy could that entail? Be education policy, or it could be housing policy, or it could be health policy. But all of those policy areas will, in turn, have some impact on the market environment and how we function as a society. And so that's what we have as an exploration and what we're hoping to have discussions about. We ask you, the students and faculty, who it is that you would like to have come and present, right? Unfortunately for us, as I was telling Dan, your first choice, Taylor Swift, declined our invitation, and so Robinhood was, I should say, a close second, but Taylor Swift. Okay, so you see where the students fell on this. Let me also take this time right now, as opposed to at the end, to acknowledge all of the Murphy staff who make this possible. Even though we're here now, this took a lot of effort, and so I'd like to specifically call out the two in the back, Dr. Beers and Catherine there. And also Dr. Howard, who you saw give the introductions. And let me just, what's that? Oh, yeah. Well, to be fair though, he didn't stand up, right? So he could really soak it all in. So So let me just briefly give you a little bit about some of the parts of the Murphy Institute, just for those of you who might not be familiar. We have 5 unique units. There's our undergraduate major in political economy, and in fact, I think some of our students are here. You will be first in line to ask questions, so hang around. We also have our master's degree in political economy with an emphasis in data analytics. We have a center for ethics because it is impossible to talk about public policy without functioning and thinking about it within its ethical and moral considerations. We have a center for public policy research because we do want to explore public policy. And we also have our Center for Law and the Economy. Because our Center for Law and Economy is what allows us to talk about policy making, rule making, or law making as it relates to the impacts it will have on the market economy. And so with that, I can finally get around to the person you came to hear, Dan Gallagher. Let me read a little bit of his bio for you. So Dan Gallagher is Chief Legal, Compliance, and Corporate Affairs Officer of Robinhood Markets. Prior to joining Robinhood, Dan was partner and deputy chair of the Securities Department at WilmerHale. He served as a commissioner of the U.S. Securities and Exchange Commission, SEC, from 2011 to 2015, and held several other positions on the SEC staff prior to being appointed commissioner. Dan's previous experience includes serving as the chief legal officer at Mylan N.V., a leading global pharmaceutical company, and as a president of a financial services consulting firm. Dan holds a JD from the Catholic University of America, Columbus School of Law, and a BA from Georgetown University. So please help me in welcoming Dan Gallagher, our Yates lecturer.
Well, thanks so much, Hoove. I want to say professor, but I think Hoove is cooler. Thanks, Hoove, for the kind introduction, and really excited to be here tonight with all of you. Taylor Swift, huh? All right, let's see what I can do here. I promise you I won't sing. That would be pretty horrible. But Robinhood's a good number 2. I'll take number 2. As we sit here, I think we're number 1 in the Apple Store for finance apps, which makes it a very cool time to be talking to you, right? That just means there's a cultural relevance about Robinhood that makes it inherently interesting right now. We've had our tough times at Robinhood. It's been a lot of ups and downs, but right now, I think given current macro conditions in the economy, given unique sort of cultural interest in things like the election last week and election contracts that we offered at Robinhood, it's just it's a cool time, quite frankly, to be at Robinhood. It feels good to be serving customers like you, and I assume we have a bunch of customers in the crowd. So a little bit about Robinhood. It was founded just about 10 years ago, maybe a little bit longer, by two founders who were friends at Stanford undergrad. They were computer science majors, math majors at Stanford, became good friends, and looked at the world of finance because they graduated. They started doing coding for high-frequency trading firms and looked at the world of finance and said, who is this serving? It's really serving big institutions. There's this lure out there that they saw Occupy Wall Street and said, let's take down the system. That's not exactly true. They didn't want to take down the system, but they wanted to bring the best of the system to individuals, to retail investors. And so they did that mainly through offering brokerage services without a commission. And most of you probably don't even know what a commission is at this point, right? It's happened so long ago, and it happened because of Robinhood. They offered trading, no commission. All of the incumbents said, this is ridiculous, this won't last, there's no way that you can finance this. But Vlad and Beju, the two founders, said, we can use technology to provide this service to folks so efficiently that we can just collect a little bit of the spread, the bid-ask spread that happens when you trade securities. We'll take a little bit of that, we'll pay off our bills, and we'll let you guys trade without commissions. By that time, commissions were somewhere around $5–10 a trade. When I was a young man, and I know we're going to talk a little bit more about career path and things, but when I was young, commissions were more like $175 a trade, coming and going, buying and selling. Imagine $175, and those are in $1980 too, right? So you can imagine what it would be today. And if you think about the thesis of long-term investing, right? Buy and hold. That's what you should be doing, right? Buy and hold, compound that return, right? The markets over time have proven to be the greatest wealth generator in the history of humankind. But you have to buy and hold. When you're taking that commission out of your principal position, it's not compounding, right? So the firms were taking it. They were also collecting, for the most part, that little bit of the spread. So they were doing fine. Robinhood comes in and disrupts. And now this business model that we've created is the norm for the brokerage industry. You don't see commissions anymore. So fascinating case study for the business school folks in disruption, all with a mission of democratizing finance for all. And you hear, it's funny, especially during COVID, we're going to democratize food delivery for all. We're going to democratize this and that. There seems to be a lot of democratizing going on in Silicon Valley. But democratizing finance for all really just means reaching out and bringing people in who wouldn't otherwise be served. And we've done that. We have we're shy of 25 million customers. Pretty amazing, because you have to be 18 to be a customer, and you're probably not on Robinhood going to be 70. So if you think about the addressable market, we've got a pretty decent chunk of that on our platform. And that's all happened in a pretty condensed amount of time. The ultimate goal here is to be the one place at Robinhood where you do all of your financial life, where you go and you trade stocks, cryptocurrency, you have your retirement account, you can have bank-like services all in one place in all the way that you live. Along the way, of course, the incumbents got upset, right? We took billions and billions, hundreds of billions out of their pockets because they all had to waive commissions to be competitive. Regulators, of course, got very interested, let's say, in our business model. The rule book from 1934, right, the statutes from 1934, which are the operative regulatory statutes that go all the way back to the crash of 1929, aren't built for an app. They're built for a bricks and mortar brokerage where you walk in, stand in line, go sit with a broker, have them charge you $175, hand you a piece of paper, and walk out. It's not meant for an app. And so part of what I personally have been doing the last 5 years at Robinhood has been trying to get the regulators with the times, right? This is how you, the younger generation, want to live your lives. You want to buy cars without ever seeing them and having them dropped off in your driveway. You want to buy car insurance on an app on your phone. Why wouldn't you buy stock on your phone? Why wouldn't you buy crypto on your phone? It's just crazy, the idea that Robinhood is the nutty one, not the regulators who won't get in line. And so it's been a rough road, and we're still hard at work. I've got my team over here, Lucas Moskowitz and Karen. We're out all the time trying to educate policymakers, regulators, academics, right? It's always important to have the academy involved as we pursue these things. But, getting used to the idea that this is how the younger generation wants to live, get the rule book wrapped around that. Don't try to quash it, but let's make sure the right guardrails are there, but let's let it thrive. That's been a surprisingly tough message. And some of the amazing benefits of technology like Robinhood, and I recognize we have competitors, there's different business models, there's folks with the same business model who think they can do it better than us, silly rabbits. There's folks that are coming at us, all the time, and the regulators just have this 80-year-old rule book, and it's very hard, to get them to change. I do think, the time is coming. The benefits are just so real. There was a proposal, of all things, out of my former institution, the SEC, called the Predictive Data Analytics Rule that was proposed over a year ago, that if it had been finalized into a final rule, would have basically killed Robinhood. That, as written, would have said, we can't use technology to provide financial services to you. Because if we do, any use of that technology basically is a conflict of interest. Because our technology is going to look at, is this the right thing? Is it putting the firm at risk? Is it within the rules? It would have to make a lot of decisions as we provide financial services to you. That rule would have deemed that a conflict, would have told us you can't do it because it's a conflict, and we would have honestly had to pull back. We maybe could have served rich people, but we couldn't have served everybody. Now, luckily, that rule, I think, has gone away. But, in large part, that's been due to advocacy. I'd like to say we did a lot ourselves, but a lot of it's also just education. We talk about our customer base, 25 million almost folks in Robinhood. Twice the average of incumbent firms of Latino customers, twice the average of African American customers. These are the communities that were being ignored and underserved, but technology can serve them, right? It's open and available to everyone. And if you look, my favorite thing is to look at the Federal Reserve keeps statistics on retail participation in the markets. So you have this little graph. It's gone up over the last 6-7 years dramatically. And if you I'm old, so I would take what we called onion paper. I don't even know if they know what that means anymore. Thin paper, and you put it over the Fed graph, and you tracked Robinhood's customer growth with the Fed's increase in retail participation. You'd see it tracks pretty well, right? And the Fed also tracks underrepresented communities coming into the retail markets. It also tracks. Technology is working. We're getting people in. The best type of financial literacy is getting in the markets. Does it mean you won't lose sometimes? No, of course. Does it mean with the right education and the right tools that you can win, right? That you can set aside money for the future, retirement, big life events, college, whatever it may be? Yes, yeah, it does. So it's an exciting time. It's still pretty new. If you look at brokerage, brokerage goes all the way back to the Romans. So, this use of app-based brokerage technology is still pretty new, but I'm very excited about it. So I'm also very excited to be the Robinhood person here to talk to you about it. I'm sure you would have wanted Vlad. It was probably Taylor Swift, Vlad, a couple other people, and then me, but you're stuck with me. I'm looking forward very, very much to your questions here, so I'll stop talking. I told you, they told me 5 minutes, but when you give an Irishman unlimited time, a guy named Gallagher coming to the Murphy Institute, boy, oh boy. This could have been increments of hours.
Want me to come back up? You want to chat?
Yeah, let's chat.
All right, so what will happen now is that Dan and I will chat a bit, and then we'll open it up to questions from you all. Is your mic on?
Is it on? Yep. Okay.
First off, let me just ask you about a term, fintech, right? For all of us, what does it really mean? And it's fairly new, right? And inside of that space, whatever it is you're going to define it as, where would you place Robinhood?
Yes, so it's a really good question. Fintech has been around a really long time as a term. It generally meant the use of technology and financial services. It's been associated with things like high-frequency trading, algorithmic trading, all these other things. What it's morphed into, I believe, so my definition as we sit here today, would be app-based financial services. That's what, folks, when you think of fintech, it's, Robinhood, Coinbase, Kraken, the crypto platforms, or Betterment, SoFi, right? All of these things are app-based. And so this body of firms with sometimes very disparate business models are all sort of collected together and loosely called Fintech these days. But I do think it's been an evolution over the decades. And where does Robinhood sit? It is funny because I wish we were better people, but we do track where we sit in the App Store. And in financial services, we're number one right now. There's a lot of crypto interest after the election last week, and so you see Coinbase is up there, number 1 or 2. It's a loose way to determine how popular the app is. That and new account openings, obviously. But if you're number 1 in financial services in the App Store, if you're number, I don't even know what we are, 20 overall, like yeah, in all apps, 12, you said? Yeah, that's crazy, right? That means people are very, very interested. So I would say my sense of it, and again, I have a bias because I'm there, is Robinhood's tip of tongue when it comes to fintech.
When you're thinking about financial services offered through an app,
Yeah.
and all Robinhood services are through the app, is there?
Everything's through the app.
Right,
And this was unique with Robinhood also. That's why the app is so awesome. And I really do think it's awesome. And again, I'm an old guy. I'm not like comparing apps and writing reviews on Reddit, but it's really easy. It's intuitive. And you know why? Because it was built to be an app. It wasn't a website turned into an app. It wasn't bricks and mortar that turned into a website that turned into an app. And I'm a Fidelity customer, so I know what that feels like. So it is built to be an app. It was built to be, laser sharp and focused, and it was built to be like other apps you like using, whether it be to buy a car or your groceries or get a dog walker. It's built in a similar way, and has won a whole bunch of design awards along the way too. So it is really important, the touch and feel of it.
Through the app.
Through the app. So,
Yeah.
but being app first, again, from a regulatory policy perspective, just threw them on their heads. They didn't know what to do with it.
Well, at some point, it had to, the phone had to evolve enough to where we started having apps, because when we first started having cell phones, they weren't really, the apps weren't the feature of
Well,
it. So.
and Robinhood's app, over time, has gotten more and more complex because there's more and more offerings, right? When I got to Robinhood in, 2019, I joined the board. And then in 2020, I came down in a management position. But when I got there, it was basically equities, so stock, options, and a little bit of crypto. We didn't have retirement accounts. We didn't have joint accounts. We didn't have all of these things that sophisticated, usually wealthier investors want from a more traditional brokerage operation. And if you sit here today, we rolled out retirement accounts 2 years ago. The assets under management in retirement has really gone up very impressively. We have joint accounts now for the first time. Our customers are getting a little bit older. They used to be, median age 31. They might be 33 median age now. They're getting married. They have significant others. They want joint accounts. They want more sophisticated things. They want retirement accounts for sure. We have, an increased crypto offering. We have a credit card now. So there's so many more things in the app too, and that's its own, ball of wax. You have to deal with making the app continually user-friendly, despite an increase in offerings.
Well, let's step back. That was an interesting way that you brought this in. You said, look, when you arrived back in
2020, sorry.
Right,
Yeah.
2020 that you arrived. What brought you in, and what's your history? Even go back further than that if you want. How'd you end up doing this at all? Right.
So I guess you have to go all the way back. When I grew up, we grew up very poor outside of Philadelphia. My father was very interested in the stock market. And I remember he used to get the newspaper, Investor Business Daily. It would come once a week. And it was just thousands of pages of stock quotes and bond quotes. I mean, it was just the densest stuff. And I would flip through it and it was like, how do you even understand this stuff? And every major newspaper, for us, the Philadelphia Bulletin at the time, would have a stock page. And it would have, the Dow Jones 100 and other stock quotes. That's how you got stock quotes. We didn't have the internet. You could watch. There was nascent coverage on cable. Cable TV was starting to come out, and you could turn on, I forget the name of the first cable. Luther, you bail me out. All right. But you could get some quotes, but you go to the newspaper and you would see a price that was yesterday's closing price. You'd call a broker, he'd charge you $175, you'd buy it, right? And my dad was very interested. He got me interested in it. The stock market crash of '87 got me kind of interest peaked in the market. We started a stock market club in my high school and had a lot of fun with that. And then went to college down at Georgetown, didn't know what I was going to do, took a year off, and was always interested in the stock market. And so I went to law school at night at Catholic. I worked during the day and worked at a law firm that had a little bit of a securities practice. And it kind of fed into my interest, and I decided to go to the SEC my second summer in law school for a free internship. They had this thing called the SEC Summer Honors Program, and I just loved it. I was in their enforcement division. It was just a top-tier agency at the time. I don't know what it is right now, but at the time was really good, and really wanted to go to the SEC right out of law school. And that program was the only way you could get in out of law school. You had to do an interview and all that, but otherwise you had to be a seasoned lawyer to go to the SEC. So I got my interview. I think I got my official offer. And at the time, the starting salary at the lowest level of the GS scale, which was the GS scale for SEC employees then, was $39,000 a year. And I had amassed, over $100,000 in student loans. My apartment cost me $1,000 a month in DC. There's just no way I could do it. I would have to take out loans to work there. So I went to work at a law firm, a different law firm that had a really top-notch securities practice. Stayed there for years, and then took an in-house job at Fiserv Securities in Philadelphia, really young. At age 32, I was the GC of this firm, and I walked in, and they were in the middle of this crisis. They had folks who are old enough will remember the market timing, late trading scandals of the early 2000s, and they were right in the middle of it. And I didn't know it. I walked in, I was like, oh God, the Philadelphia office of the SEC was all over this place. And I spent 9 months getting this case settled. And at the time, it was one of the biggest failure to supervise cases in SEC history. It was a $15 million penalty. And our COO got suspended for 9 months. It was a big deal. And right when we got it cleaned up, the corporate parent decided to put us on the block and sell us. So I spent the second 9 months selling the place, which ultimately we did. We sold it to Fidelity. And then I went back to DC, ended up at the SEC working for a commissioner, and then a chairman. During the financial crisis, I was down in the Division of Trading and Markets. I was deputy director responsible for investment banks, so that was a lot of fun. I took that job 6 weeks before Lehman and had to deal with all the Lehman fun. Had to deal with Bernie Madoff and the Madoff scandal, which was a huge, horrible, Ponzi scheme that just ruined so many lives. But at the SEC, it had real-world consequences too, because we oversee the Securities Investor Protection Corporation, which is the insurance program for brokerages. So how much are they going to give out to customers? And then I went back to my law firm for a while. I was happy as could be. They asked me to be a commissioner. Did that for 4 years. And when I left the commission, it was sort of interesting because I'd been a law firm partner. I'd been in-house at a brokerage firm. And the question what do you do with this weird credential? You're a former SEC commissioner. And if you look at the history, it's a mixed bag of what people do and how successful they are. So you're like, I have no idea what to do. And I did some consulting for a while, but then ended up at this pharmaceutical company. Craziest story. They wanted me to join the board. I couldn't join the board because our law firm had a conflict. And they said, come be our chief legal officer. It was the company that had the EpiPen pricing scandal in 2016. And they needed help sort of with the government cleaning that up. So I went in there and worked with them for a couple of years. Ultimately came back to the law firm. And as I came back, there was a Stanford professor who's also a former SEC commissioner. His name's Joe Grunfest. I don't know if you've ever encountered Joe. But he's a very good friend of mine, and he kept calling me, saying, you need to talk to these Robinhood founders. You know, I don't know anything about broker-dealer issues, and you know the broker-dealer issues, and they really need help. And I was like, I don't want to talk to these Robinhood guys. The stuff I read, you know, forget them. You know, the stories had been written. They're going to be the Uber of brokerage. They're going to break all the rules and then ask for forgiveness. And I was like, I don't need to deal with that. And so for about a month, we went back and forth. And finally, I said, all right, I'll meet with one of them for you, Joe, just as a favor for you. And I met Baiju Bhatt, who was one of the founders, thinking he was going to be some arrogant Silicon Valley billionaire type, and couldn't have been any different. Okay. Just one of the most wonderful human beings I've ever met. So curious, with a huge brain, incredibly curious about Washington, regulatory policy, how does this stuff work? How did Robinhood, at that time they got themselves into a little hot water on a couple issues. How did we do this? Do I not have the right people around me? Why are we making these wrong decisions? And that turned into a conversation between me, and Vlad, the other founder, who I also then shortly thereafter met and just also loved for different reasons. Very different people. Baiju's super gregarious. Vlad's a little more cool and intellectual, but just wonderful human beings. Really smart folks, and folks who just want to get things right. And they asked me to join the board in 2019, which I did. And then 7 months later, COVID hits, all hell breaks loose. Everyone is sitting on their couch and they sign up for Robinhood and start trading in March of 2020, and the app blows up, right? We were down for a day and a half, and it was like, oh Lord, this is a catastrophe. And as part of that, the chief legal officer who'd been there was a wonderful woman, formerly the CLO at WhatsApp, but she was like, this is too much. Right now I've got, personal issues I'm working on, but also I'm not a financial service. I'm not a regulatory person. I'm a tech person. And this woman was amazing. We couldn't convince her to stay. So I started what I call the Dick Cheney search for the new general counsel. I legit went out, got all these names and vetted them and presented them to the founders. And then Baiju said, I have one question about these three. Why not you? And I was like, oh God, that's what I need right now. COVID is happening, the world is ending, and I was like, that's the last thing I need, that stress. I've been through some pretty crazy stuff as far as crises in my career. My wife really didn't want me to jump into another one, but here I am. So I joined in May of 2020 in this capacity, Chief Legal Officer. I've grown my remit there. I've taken on corporate compliance, so public company compliance. I've taken on, we call it corporate affairs, it's some comms, financial crimes, which is our AML, KYC role. So we have about 200 people in the department that I oversee now. So, bet you didn't expect that long-winded answer to a simple question, huh?
It's your time. That's what they want to hear about. Look, let me circle back to something you said before and put this into context here. What about the policy, right? So we know that these agencies impact policy, and then those policies are going to impact that market environment. And where in the policy world, and because that's what we do here at Murphy, right? We're concerned about the policy world. What would help as far as public policy to democratize financial services, right? Which is what the goal of Robinhood is, as I remember you saying. So to that extent, what policies help us democratize financial services for all?
Yeah, I think, so I can speak from the Robinhood perspective, but I think it's broader, right? Yeah. Any policies, wherever they may be, the SEC, FTC, FINRA, don't get me going, that allow for an environment for this technology to thrive, to really reach people, is a good policy. A policy that says our 80-year-old rule book doesn't accommodate your app-based services, and therefore we're going to bring enforcement actions against you. We're going to demand penalties that, the size of penalties paid by Goldman Sachs, even though you're a pre-profit, nascent public company. Those are bad policies. And unfortunately, for the last 4 years, it's been a slugfest. The notion in Washington, from a regulatory policy perspective, has been, and there's no better way to describe it, as a nanny state policy perspective. We need to protect you guys from yourselves. You can't be trusted on a Robinhood app. You can't be trusted on a Coinbase app because you're going to do something, you're going to lose money. You're going to go on there, have a few beers and buy Tesla stock. Who knows what it is, but it's this notion that the government is going to protect you by not letting you have choice. That's what it really comes down to. And it's crazy. I mean, it flies in the face of human history, by the way. Technology marches on. It will advance. But that's what we've had for the last 4 years. From our perspective, through FINRA, and with top, oversight by the SEC. And why do we have it? Why is it this attenuated? And we feel it acutely. We've felt it acutely at Robinhood. We've had no less than 5 federal rules proposed that aim to severely impact our business model. I mean, Gary Gensler proposed a rule that would have mandated all of your orders that come to us for stocks, that we send them to a stock exchange. Okay? Do you know why we don't send them to a stock exchange today? Because you get worse prices and slower execution. We cannot satisfy our duty. We have a duty of best execution under the rules to do our best to fill your order. We can't do it right now on the stock exchanges. So there's this quaint notion that if you send things to the lit markets of stock exchanges, it's just better for everyone. It's just not. It's slower and it's more expensive. We do better sending them to 7 or 8 market makers who compete for your order, and they know that your order is safe in the sense that you're not some hedge fund trying to make money off of them. So they'll pay for it. They'll pay us for it. They'll pay you for it. You get price improvement, and Lord knows the majority of orders that come through Robinhood. So there was a rule that actually did that. Now, hopefully it's dead after last week. There was another rule that was designed to change the increments in which stocks are traded, getting at the same issues. There's another rule, an SEC-based Best X rule when FINRA has its own. So just duplication. Makes absolutely no sense. But just because one person thinks there needs to be a official Best X rule, that FINRA is not official, and that one person's Gary Gensler. So, and then this PDA rule that I mentioned, gosh, I'm missing one, but 5 rules, we've weathered them. We've weathered the crypto onslaught, right? No rules, just enforcement. And here at Robinhood, my goodness, we've run this platform like it's a brokerage firm. We've brought all of our learning from the brokerage firm about safety, customer protections, tax reporting, we actually do tax reporting. We did it before anybody did, to the crypto platform. We try to be transparent. We keep the fees down. And we don't list things that are securities, because then it would be regulated by the SEC. And despite that, I've had to pay millions of dollars to outside counsel, much management distraction, defending ourselves against an SEC investigation on crypto. I've got FINRA in my house every day, looking over our shoulder, telling us, oh, you didn't do this right, you didn't do that right. Should this person be registered? That, again, an example of an 80-year-old rule book that they're trying to fit around our business model. And if it doesn't fit, it's our fault. It's let's bring an enforcement action instead of rethinking these rules. And I give them a little bit of credit. They've created a couple new committees. They actually created a committee called the Self-Directed Brokerage Committee to try to start figuring out this new business model and maybe change their ways. They better hurry up, because the number of brokers in this country has been declining rapidly. When I was on the commission, I think there were about 5,000. There's 3,300 today. And the number of investment advisors, which they don't oversee at FINRA, by the way, the SEC oversees investment advisors, it's going up while brokers are going down. So FINRA's sit a big block of ice sitting in a driveway on a hot summer day. So I think policy's been radically wrong vis-a-vis fintech, especially in the last 4 years. And I think, with putting aside the politics of last week, one thing for sure about last week, even if it had been Kamala Harris, a change was coming, right? A change is coming. The intolerance to this stifling regulatory climate is bipartisan and very widespread. And so change will be coming, and I do think it'll be a good era here for fintech to make some gains while at the same time not shirking investor protection. I mean, there's no reason you can't have investor protections because you're doing things on an app.
All right. I have dominated way longer than I was supposed to and was allowed to, but I'm sitting in the chair, so I got to do that. What we're going to do now is we're going to open it up. Let me, where's our staff? The staff hold the mic. You get to ask the question, but the staff holds the mic. So let us, to be fair here, the first question should always start with a student. So are there any students who, I'm giving you an opportunity, watch they don't do it. I'm giving the students an opportunity to ask the first question. If not, we'll move on to other folks who might want to. Students, please don't make me look this bad. One of you try. If someone has their hand up? Oh, okay.
So what makes Robinhood different than like other online trading, like Acorns or like E-Trade and all that sort of stuff?
So each one is very different. I would say, take the last one first. So like E-Trade, very similar. I'm staring at my dear friend from Morgan Stanley right now. E-Trade, though, is the evolution of, I mean, they were the Robinhood of 1998 or whenever they got really hot, because it wasn't bricks and mortar, it was a website. And that was huge. I mean, the revolution in stock trading that E-Trade brought, we're riding the coattails of it at Robinhood, I can tell you that much. I mean, that was the disruption of the 90s and early 2000s. And now E-Trade, and I'm an E-Trade customer too, we use E-Trade for our stock plan administration, is like what I said. I mean, E-Trade provides very similar services. It is a website to an app type thing. It's not app first, right? So it would have a different look and feel. But very similar business model as far as being a brokerage firm. Different, I don't think E-Trade got into crypto the way we did. Yeah, and futures, right? Acorns is, I think, an investment advisor. So different business model. I think Acorns is the one you take a little bit out each month, yeah. And it's managed by AI, right? It's managed essentially by an algorithm that looks out for your best interests and tries to allocate your money the best way possible. Different regulatory regime, which makes it a different business model. So there's brokerage, which is, it gets complicated. There's full service brokerage. You could come in and I could be a broker and I could say, hey, I think you should buy 10 shares of Tesla. That's a recommendation. And when I make that recommendation, I need to know it's in your best interest. Or I could be an investment advisor and you could come in and I have a fiduciary duty to you. I just have to look out for your best interest. I have to keep monitoring your account and making recommendations based on that monitoring. And I get paid. This is very important. The key difference is I get paid basis points on assets under management. So I get 20 cents for most robo-advisors, 20 to 50 cents, based on AUM. And then brokerage is just a transaction fee. So you come in, basically trade for free with us. There's been a lot of consternation about what free means. We do collect a little bit of a fee from the market makers we send the orders to. They take the bid and the ask, and there's a delta there. Say it's 10 cents. They'll take the 10 cents, they'll keep 8 for themselves, they'll give us a penny, they give you a penny in price improvement. that's just rough numbers. I'm not telling you that's the average, but just so you can conceptualize how our business model works, we get that money. Same thing on options trades. We use rebates in crypto, so it's different models for different product. But really, the regulatory regime actually creates the different business models. Robinhood soon, I don't know how soon, we'll have an investment advisor, so we will have a model where you can come in, we'll charge you under assets under management. It's all advisory. We're not getting paid on transactions anymore. So we'll have both sides of the house, covered from a business model perspective. Betterment, Wealthfront, Coinbase is crypto. They don't have brokerage, but there is like Webull is a competitor. I think they had crypto. They have crypto, but they basically try to do the same thing we do with stock and options, things like that. So you have to just look at each one, see what they offer, and see how we get paid to understand what our incentives are. Read the disclosures, even though I know you got to read these disclosures. They're a pain in the neck, and you're scrolling through them, but understand those differences.
Somebody else? All right, we'll open it up beyond students now. Let's see. I think Mario had his hand up first. Where you got Mario? Somebody will come to you.
Oh, there he is.
There he's right here.
Thank you for your talk. So I have a ton of questions, but I guess I will ask this one. So when talking about regulation, and especially the regulation that would, let's say, protect us from ourselves, so I wonder whether you think that there is one that you would support, or if there is none, like that will also be, like I would hear that if you think that there should just not be a regulation that protects from itself, because I can see a case made for like, don't, because of the immediacy of the investment, right? Like don't drink and invest or something like that, right? Or like, I mean, like I found like I think it's like a car, right? In some sense, like. But in a car, you are harming someone else. I just don't know. So I'm asking you, like, what do you think is the risk, and whether there is a risk against or that we have a risk or harming ourselves or harming someone else when we have this immediacy of investment, and whether you think that if there is that risk, there is an appropriate regulation or there is non-regulation.
Yeah, it's a really good question, and I'm a very, very free market person. I think that you should have the ability to do as well or as poorly as you want when investing your money. I hope you do well, especially if you're a Robinhood customer. And our customers tend to do well. They actually tend to buy and hold, which is contrary to what most people believe about Robinhood customers. I think the best protection is diversity of product offering. Just to go back to the answer I gave to this gentleman over here. If I only offer you, which is the Robinhood legacy, if I only offer you the ability of self-directed brokerage, right? So there's full service brokerage. We have a broker, he's advising. He's not necessarily monitoring your account, but he or she, is recommending things to you. Then you have self-directed. Self-directed is what at Robinhood most people want and have gotten. You go on caveat emptor. We don't recommend anything to you. If I recommend something to you, this is how perilous it is for me. If I recommend it to you, I trigger a rule, regulation best interest, that I can't satisfy. Because the rule says I need to make sure the trade you picked is in your best interest. And how do I know that? Right? Because I'm not a fiduciary. I haven't agreed to look at all of your holdings. I haven't looked across your accounts. I haven't done those things that a fiduciary might do, or a broker with a Reg BI interest or duty has done. And so I think making it very clear what the business models are, like this self-directed brokerage is caveat emptor. And I can tell you, as I told Gary Gensler 4 years ago, it's also as American as NASCAR and apple pie and hot dogs. People want it. They have it. Sometimes they don't tell their significant other about it. They want to trade. They want self-directed brokerage. They don't want anybody looking at their other accounts. They don't even tell them about the other accounts. And they love it. It's hugely popular across all these firms. Not just Robinhood, E-Trade, Morgan Stanley, everywhere. People want self-directed brokerage. And a lot of the policy over the last 15 years in DC, whether it was Department of Labor had a rule, the fiduciary rule that was going to come out, if you handle retirement assets, then you have all these obligations. It basically was going to kill self-directed brokerage because it used to be supported by commissions. It said commissions were a breach of fiduciary, long story. But I think if you can go onto the app, clearly understand the difference, you're signing up for a fully recommended brokerage offering, that's your protection because we've got skin in the game with you. There's reg best interest out there that says we need to make sure this is in your best interest. We're looking at it. If it's an advisor, it's basically, you can meet with your advisor and ask for things, but they're the ones usually making the recommendations and calls, which are meant to be in your best interest. That's your protection. But if you want to tell me that you can't have self-directed brokerage because you can't be trusted from having a few beers on a Friday night, I don't subscribe to it. I don't think that there should be a rule prohibiting it. If there's a rule prohibiting that, just think about gambling apps and everything. Like, humans do what humans do. Some folks, some will get hurt, and believe me, we don't like to see that. And I had to sit there and say to a congressperson at one point, like, you think we like people losing money? It's the worst experience possible. If you're trying to provide a service to somebody and they're not doing well and they don't like it, they're not coming back. They'll close their account, they'll leave. We want everybody to win. But the notion that we should tell you when and you should and should not be involved in self-directed trading, I don't buy. I think the contours of all the regulation are there. They just need to get with the times and understand that all these rules they have in place can and should work in an app-based environment. They haven't done that yet.
So we're going to have time for two more. So who wants to, because we want to be respectful of Dan's time. How about the gentleman in the glasses there in the middle with the blue, I think his name is Benjamin. No, sir. He's pointing to himself, and Catherine is looking way past him. He is sitting right here. Yes, that young man.
So this is maybe just a little follow-up on Mario's question. Is there now, or might there ever be in the Robinhood app, some way where users could introduce their own frictions here? So I might like the idea that I can frictionlessly buy and sell Tesla stock, for example. But suppose I open an IRA and I put all my retirement in and I go get drunk and I sell it with disastrous tax and other implications. I maybe don't want the government to tell me when I can and can't execute a trade on that, but I might want to say I have, take my grandma who had an Edward Jones account. If she wants to make some kind of change, it's going to be weeks. She goes in, she talks to a guy, a thing happens, and was probably a good thing for her with respect to all of her retirement savings. Maybe you don't need that much friction, but I might want to self-introduce a few days of cooling off. Is that something that might be added to the app, or is it there now?
It's not there now, no. I think it's an interesting question. I think in the world, again, of product diversity where you have your IRA as an advisory account, you're not going to be able to you can have as many beers as you want on Friday. You're not going to be able to just sell it off, right? Because it's managed by the robo-advisor. In self-directed brokerage, there'd be more frictions involved before you could do that. In full-service brokerage. In self-directed, I wonder. I don't know. It's a good thought whether you could put some speed bumps in for yourself. As sitting here as the chief legal officer, it horrifies me, right? Because it's one more complexifier, as they would say, right? That you put in some speed bump and for whatever reason, the system didn't adhere to it. You went out to your vendor and you woke up with no Tesla and now you're coming to me because you want your Tesla back, right? Anytime you offer things like that, obviously you got to factor in risk to the firm too. But I will ask that question when I get back to Menlo Park because I just don't know if we've debated it, to tell you the truth, within the self-directed offering. Yeah, and again, the evolution team of this app it's just incredible. When I started, I tease Vlad all the time. It was like this was like a lemonade stand. It's a brokerage firm with NMS equities. We don't offer bulletin board stocks. There's no short selling. right? There's no joint accounts, there was no tax lots, all these things, which we're getting as the years go by, we're adding all these features. But it was so rudimentary, right? Very, very basic offering. So now we're getting to the point of refinements, like we just announced tax lots, right? That we're gonna be rolling out. People were like, oh my God, it sounds so mundane, but it's so critically important. So these types of features are now, we're at a maturity level at Robinhood where we can talk about things like that, so.
Well, let's let the last question go. What's it?
We can go over a couple minutes. Yeah,
All right, well, let's give Doug one, and then if
So thanks
Dan
for
still
coming.
feel- oh, I'm sorry.
Just want to hear more about the SEC. You've had a lot of experience with the SEC, and you've on the one hand talk about it as, well, we need investor protections, but it shouldn't be a nanny state. And then I think about like what your business has been. You guys have done pretty well, it seems, under the SEC. So I'm trying to figure out what exactly you think the role of the SEC is, and what is it doing that's actually stopping you or these other companies from doing what they want to do? I haven't heard anything that's specific about that.
Okay, there were 5 rule proposals that were.
Happened, right? So there were proposals and you had to fight against
couple of them actually happened. Some didn't because, you know, they saw the light. But I don't know how much I've spent, probably over the last 4 years during this administration, well north of $50 million in legal fees dealing with the SEC on a pre-profitable enterprise. The hostility towards the business model is real. And what the SEC should be doing, it has a tripartite statutory mission: protect investors, ensure fair and efficient markets, and facilitate capital formation, right? You shouldn't take that first piece, protect investors, and turn it into what I said, the nanny state. We're gonna protect you by giving you no opportunity. We'll only let rich people have access to the markets we oversee. That's a crock, and that's what's been happening for decades. Through.
right? I mean, so you had to spend some money and fight off some rules.
So do you think, I mean,
doesn't seem like
right, but in this world, should a brand new startup in Silicon Valley have to hire a former SEC commissioner to be their general counsel to survive? I'm asking you. Should we have to pay $50, $100 million in legal fees, right? Should we have to pay FINRA $50 million penalties just because their rule book isn't set up, you know, for this new industry? I don't think so. So
we're in a new world, right? You have all these new technologies. You have the regulations haven't caught up. It just seems like it's natural that it's going to take some time to sort this out, and that there's going to be this haggling, and that companies are going to have to be involved in the haggling in the process. It just doesn't seem like it's crushing things the way you're making it sound like. It's not crushing. You're doing what you're doing. It sounds like your business is doing great.
the business is, business is doing very well despite this. You know, the things we could have been doing instead of focusing on this regulatory pressure, the things we could have been doing instead of trying to force these policy changes coming from the private sector in the headwinds of an SEC and a FINRA that are very hostile to the business model, could have been great. We could have served more people. We could have brought more people into the markets, but we haven't been able to. So, yeah, I wouldn't skip to the end here and say everything's great. It's the last 4 years, I can tell you. I've got the scars to show you. And, it should not be that the next Robinhood needs a former SEC commissioner, division director of trading and markets to wade their way through it.
All right, let's the gentleman right here in the hoodie has tried 4 times, so I saw you, but okay, so go.
Thank you so much. So I'm thinking of a potential burst of the financial bubble. Like now, okay, fintech makes investing in crypto, ETF, stocks way more accessible. This could lead to a eventual bubble like we saw when mortgages got more accessible in 2009. Starting from this, my question is a normative question in the sense of does Robinhood have certain ethical responsibility here, or is just the customer's responsibility? Because in my mind, I'm a big fan of such platforms. I use self-brokerage myself, And it's true, this is self-brokerage, and you take the decisions, and there is no direct advising, but to some extent, at least in the platforms I'm used to, there's certain nudging. So I can tell these platforms I use, they will put crypto or ETFs or stock that are more risky, that I guess this has bigger margins for them.
Right.
On the front of the page, their marketing strategy is directed that you go for crypto. Also, you can argue, well, your market strategy is this because you know crypto is what people want to invest in, so you just give people what they want. That's your market strategy, which is legit. But then at the end, if there is a burst in the bubble, is there a responsibility from you that you probably have the best financial insight of what are the most overpriced assets, or is still the responsibility on the people buying?
Yep. So, so you're talking about a couple things, I think, right? So the sort of regulatory duties you have, right, as a brokerage app that we talked a lot about, right? And if I'm nudging you to do something, right, to buy a risky crypto because I get paid more, that's most likely going to be a rule violation of some sort, even in crypto, right? Even if it's just basic fraud. I'm doing one thing and saying another, right? This is safe, but I'm making more money. I'm not telling you. In the brokerage world, right, again, we studiously avoid trying to tell you what to do, because if we do, then we take on an obligation that the business model is not built to support right now, the Reg BI obligation, right? So painfully, like the way we even present you lists of securities and things like that, I mean, we've had FINRA all over us, because it's got to be done sort of in a random way, so it's not looking like we're actually recommending something to you, it's just what you want to see. So we very carefully avoid that. You know, and again, the general notion that you would nudge somebody to do something that's probably bad for them and good for you, and it's undisclosed, like that's just plain fraud, bad business model. And I think, you know, look, and I can't speak for all of crypto. We treat our crypto just like we treat regulated businesses. So, which is hard because there's no rule set, right? We just try to use our best instincts on what regulators would want to see in crypto. I think this idea of a collapsing bubble, I mean, we experienced it, right, in 01 with crypto. We saw the rise. We experienced it with the meme stocks also, right? It happened, and a lot of it happened on Robinhood. You know, was it a bubble? Certainly wasn't a bubble like the mortgage bubble, right? It was a thing, right? It wasn't an inflation of a certain asset class because of macro conditions. It was a thing. People got on Reddit and did what they did. But it's happened, and so we've lived through it. And, you know, what are the ethical obligations there? I mean, for me, it's not so much ethical as, again, as long as the regulatory obligations, which when you think about ethics generally, like what are the norms, right? You're looking at the norms for the industry. Those are set by the rules. As long as we're complying with those, I think, you know, that's fine. I don't worry about, and I don't know if you're asking like a systemic risk question, like you know, the mortgage bust and things like that. I mean, we could have a whole separate lecture and discussion about what caused that, what causes one asset class to become favored for policy reasons, you know, for practical reasons, opacity in the markets, regulatory confusion, which we had, all of that back in 07, 08 that led to a big crash. I think that's just very different than buying and selling exchange-traded equities or you know, transparent crypto options, other products like that. So I'm not worried about systemic risk necessarily, but I think you're talking more about sort of like herding behavior, which happens sometimes in asset classes and can't always be controlled. And, you know, it's fascinating, you know, to go back, you know, to the whole impetus for the SEC to bring this mindset to bear for the last 4 years. If you think about it, most of it arises from GameStop, right? GameStop happened right when Gary Gensler's being confirmed. And it was like, there's the government watching. Folks are on Reddit. They're agreeing to do something. They did it, right? It was only illegal if they were lying on Reddit, right? Saying one thing, doing another. I mean, the legality of it is really a tough thing to prove. Were you manipulating the market or not? It's a dog of a case for the SEC to go investigate people on Reddit. I can tell you, I've been there. They don't want to do it, right? So instead of that, it turned into, oh my gosh, payment for order flow, the model that we get paid for. Gamification of apps, all of this caused GameStop. And therefore, we need a whole bunch of rules designed to get at those things, right? Blame the apps, blame Robinhood, right? And I think that was completely misguided, right? Instead of getting at the real causes of GME, we have an extended settlement cycle. We actually shortened that, and I give Gary a lot of credit for getting that done. It needs to be further shortened, but we can talk about that. But getting at herding behavior, getting at social media-based trading, have fun. That's that's beyond us, and that's quite frankly even beyond the remit of the SEC. And it's been that way for decades. Ever since the internet arose, there's been an inability and a lack of desire to try to track people down who operate in the ether and talk about stocks and try to drive herding behavior.
Let's do this. The young man who looks like a student shall lead us out with the laptop over against the wall. This shall, even though Dan has been really gracious with his time, I really appreciate that too.
No problem.
Let's see what our students have to say. Give it to us.
So I've definitely seen the Robinhood credit card and have been interested in that a fair amount because it seems like from what I saw online it offers 3%, which seems reasonable. And with thinking of Robinhood originally as something kind of make investing for retail investors more available, is the credit card gonna ideally do the same thing and make credit more available in the same way that Robinhood did for investing?
Yeah, it's a really good question. Yeah, that's our basic thesis with any product we roll out. It's to democratize things, right? So to make it more available to everyone. So 3%, I'm not going to make claims because it's industry maybe leading or tops in the industry as far as cash back, right? And that'll be available for anyone who has the card. And we're trying to roll out the credit card as much as we can to folks, who want it. That's usually, it's been a perk reserved in other credit cards for folks with certain levels of assets and things like that. We're trying to, democratize that. And the fun part is, and I have mine, I wish I brought it actually, it's really cool. I have one of the few solid gold ones. I'd pass it around to you and show you, but when you use your card and you pay, you earn points and you redeem the points. You can redeem the points in a whole bunch of ways. And my favorite is I redeem it for cash in my brokerage account. And you literally hit 2 buttons on the credit card app, sweeps it over to your brokerage account. And if you're currently a gold member, you get 4.5% on that cash. For a little while it was 5.5%. You can let it sit there and just collect the interest. You can invest it. You can buy a fractional share of Tesla or whatever you want. I keep saying Tesla, but just because our customers love Tesla. It's always a top stock. So, there's other ways to invest it. You can ship it over into your retirement account, things like that. So it's just, it's very Robinhood. Democratizing it means, and credit card is a whole different business, right? Making it available to folks with varying credit scores and getting into subprime and things like that. And, it would be good to be able to offer it to more folks. That way folks who might otherwise not have a card, but you have to be, the rules there and the considerations are very, very delicate because you need to take into account the risk of the firm, right? You're literally out the money if somebody doesn't pay, and so you got to have, make sure you're really buttoned up on risk management. So I think you'll see us developing the muscle over the next couple years with the credit card and offering different features with it, hopefully expanding that base so we can really democratize access. But we're just at the beginning stages right now. It's really cool though. And again, it's, when I got to Robinhood, all the claims from analysts and Wall Street was it's this, single business line, they're at risk, from regulatory changes, they're not diversified. And it's just amazing to see, with credit card and international expansion and options and crypto expansion, we've diversified the business model so tremendously. And I would say that the credit card is one of the more exciting new products that we offer. So stay tuned.
And on that note, I just want to take this moment to thank Dan Gallagher for spending his time to come and talk to us when there is just so much going on, and he's so very busy, and he came by. So join me in just thanking him for this really enlightening.
Thank you. Thank you, Professor.